Hey, it's finally happening. This is what you wanted. This is what you were asking for. We're heading into a beautiful earnings season where we know companies are going to crush, probably beat expectations across most of the board. Yet here we are, stocks getting cratered. Why? Not for logical reasons like overvaluations. No, geopolitics, the clowns that we elect that run the world are cratering us, and I think it's hilarious. I mean, it's kind of funny. Here we got Donald Trump, the king of the clowns of tariffing and insanity, saying some very strange things are happening in China. They're becoming very hostile. They're sending letters to countries throughout the world that they want to impose export controls on each and every element of production having to do with rare earths, virtually everything else they can think of, even if it's not manufactured in China. Oh my God, nobody has ever seen anything like this, but essentially it would clog the markets. Oh no, and make life difficult for virtually every country in the world, especially for China. What are we to do? I'm being really hyperbolic. I'm sorry. I know you get it, right? Like Trump was literally just causing tariffs and like import bans and everything back in April. And now we're surprised China's doing the same thing on rare earths. I thought China was the enemy. We don't need China. We can bring manufacturing back to the States. Oh, wait, China's like every other country. They have control. They have major rare earth exports. Maybe they do matter. Maybe we shouldn't have been such douchebags toward the country that could control like the things we need to make chips and all the value supply chain that we use across our products. Oh my God, who would have guessed this could have happened? No, like, you can tell I don't care, right? Like, obviously, I could give two craps about geopolitics other than I appreciate that it is opening up the window of opportunity to buy great companies. And obviously, if you're invested in the Canadian economy that was supposed to be the 51st state, guess what? There's a reason Trump wanted Canada to be the 51st state, because we have so many damn rare earths. And you'll notice the Canadian markets overall aren't getting like nearly hit as hard for those reasons. But obviously, like the whole markets are going to come down because people sell broader ETFs that will bring down kind of our mining companies. But I think this bodes really well for the Canadian investor out there. And we're going to talk a little bit more in depthly about it while answering some of your comments, questions about building out retirement portfolios and so much more in between. Obviously, my spreadsheet is not updated. We're going to be down quite materially, and I want to talk about it. So if you're on a path to financial independence, if one day you'd like to retire early, join me on that journey. Hit that subscribe button, folks, because my God, I just wish this would have happened sooner. I've been buying a lot of stock. I buy the highs, I buy the lows. I like getting aggressive when the stocks tank materially, and I don't really think this is much of a crash yet, to be honest. Like, I'm hoping this continues and we get maybe like a 5 or 10% sell-off. Whew, that would be sweet. But someone said, need you do a full-on ETF portfolio for those in retirement, like your parents? A lot of people that watch this channel are kind of moving into that retirement phase, asking me how to build out a retirement portfolio. And in market conditions like this, you kind of want to cushion and condition yourself to not have to worry about it all that much. And I'm going to give you a few ETF recommendations, not as financial advice, but ones that I focus on in my parents' retirement that I think could be used as foundational holdings. And then from there, I mean, you could look at higher yielding ETFs, some individual stocks, or whatever you want to speculate on. But I really like the BMO International Dividend ETF. And I'm only stating this one. It does come with a higher expense ratio, but I like this one because it's done in Canadian dollars. I gave you a US recommendation, but I think for Canadians that don't want to convert capital, that this could be a good ETF to start with the international side of things. So you're getting about a 0.44 expense ratio. If you minus the expense ratio, you're locking in around a 3% yield on this one. And if you look at the holdings, again, this is just for that pure international exposure that I've been recommending as of late to start, building out that global diversity. But there's like thousands of stocks in this ETF, I believe. Rio Tinto. I mean, I've talked about it before. Nestle's in here, Toyota, like great companies to give you that foreign exposure. Then for the Canadian side, as somebody mentioned, I think in retirement, if you put VDY aside, the two best ETFs I think you can pair together to still get some growth but higher yield is XDIV and XCI, which we've discussed relentlessly on this channel, which you'll see aren't getting hit nearly as hard as the broader markets today, getting that juicy, wonderful Canadian exposure with our beautiful rare earths. And then finally, maybe plopping in a little bit of SCHD, for some of that US dividend exposure. And then from there, I mean, you can broadly expand into whatever you think you're missing out on. Like, obviously, if you want more real estate exposure, I don't like the Canadian REITs personally. You can look into Canadian REITs. I like the US real estate market. You can look at something like V&Q. But what you really want to start doing is in your mind, and I can't tell you how to do this because I don't know your time horizon, your income levels, your CPP, the dividends that you're required, all that in between. If you want to have a one-on-one discussion, again, not as financial advice, go to kylelivingston.com. Links in the description below. But hopefully that kind of just gives you a start, right? My parents retired. They hold XCI and XEQT, and I hold some ETFs since I never know when I'll decide to stop working. Exactly. What accounts are you prioritizing right now and in what order? I've talked about this and I answered his question, but regardless, I'm still trying to max out my tax advantaged accounts after purchasing this piece of real estate 2 years ago. My TFSA is almost maxed. I've been working on my fiance's. She's still, I believe, got like combined between both our accounts, I think we're sitting around $50,000 worth of contribution room still. And for me to be what I would consider financially free is I want to just finish maxing out my tax advantage accounts and paying the mortgage off. If I can achieve that by 35, I think we'll have enough capital that just to make 5 or 10% on our combined accounts would equate to like a full-time salary. And that would be kind of like the cushion to say, hey, we don't need to be slaves to our jobs anymore. And it would put us in the position to be quite happy. You'll notice my corporate account is ballooning. And the reason that is I can't pull that money out. Like I'm already in a higher bracket. My fiance is getting into some upper brackets because I do pay her out as she works for my company. And it just kind of gets a little bit complex at this point to just being able to pull all this money out, max out the TFSAs and pay the mortgage off with what my corporation holds. So while my corporation makes money, I just leave it there and I invest it for the time being as it's more tax efficient. Regardless, I want to talk about the valuation aspect of things because people keep screaming that we're overvalued, and we're going to go through these cycles all the time. We're going to be overvalued, undervalued, overvalued, undervalued. I wish we would still be in like where the markets were back in April. I think that was like the best value point for pickup, and it really only lasted like a month or two, and now we're just like screaming back to levels that were closer to being seen at the peaks of like 2021 where we hit like a 35 PE. But I want to remind you that history doesn't really repeat, it rhymes to some sense. And I think we're in a bubble when you look at secular markets when it comes to quantum computing. I think there's a lot of crypto markets that are getting bubblish. I think you're looking at a lot of clown stocks that people are pumping that are trading at just absolutely extraordinary values, pulling ahead extreme levels of growth. Like, I mean, you could say this is the same, like Oklo. I think we're seeing it in a lot of smaller cap companies that have ballooned into billion-dollar value ranges, but aren't even making close to those levels. And I think those stocks are the ones I would fear the most. I'd be careful with them. Just, high growth companies, there's nothing wrong with speculating on them, but just be aware you want to look at foundational stocks. And I would still put, and I think Nvidia is expensive, but you have to look at the pull forward valuations, right? Because these companies heading into earnings season are beating earnings. They're crushing it. And you could look at Nvidia and say 53 times multiple is insane. And the only reason I'm scared of Nvidia is because Google, Meta, I think 40 or 50% of their income is coming from like 3 or 4 companies or something like that. So if those companies decide to cut CapEx anytime in the next few years, Nvidia will absolutely get slaughtered. But for as long as this train of AI and building out data centers continue, guys, the forward value on Nvidia is a 29 for next year. Like that's fairly reasonable, right? And if you look at that from the lens of guidance into next year with Apple trading closer to a 32, Microsoft trading at a 33, Google, oh my God, down 1% again, getting back into that value range. I'm kind of glad I took a little bit of profit off the table. We're getting back into what soon will be a buying range for me, especially if it starts materially tanking back down to that 220 range. Oof, juicy. But a 23 on Google, Meta, 24 right now. Come on, guys. Like if these stocks tank like this, again, you can't tell me that these aren't good buying opportunities. Royal Bank, I mean, look at the Canadian banks. They're going to be doing some good value adds here in the next year. They're not getting caught in the midst of this sell-off is hard. Because again, the Canadian markets, I think, have those rare earths. It's just the broader ETFs being sold off that are probably bringing this down. But I mean, the forward PE on Royal Bank right now is a 13.6. It's not like unreasonable, right? So when I look at the markets as a whole, guys, you got to admit, like, things are still pretty rosy. I mean, yet they're expensive. They're not cheap. If we get a nice value correction here, 5 to 10%, I think that would be a great buying opportunity. Something tells me, because this is a total clown market that is, only being controlled by geopolitical events, that this is going to be just another hiccup in the run of a bull run. Like, we need something material to shift people's minds like we did in 2021 when the interest rate cycle began and people only cared about earnings. Earnings were the only thing that mattered, and companies just shifted up, cutting CapEx spending and all this stuff. Until you can get that material shift in the economy and spending starts to freeze up, this is just nothing more than a buying opportunity. Like you really need a crazy material shift to get a real crash in the market. And the only thing we're going to see happen is those clown stocks get absolutely hit. I mean, anything trading at high values, a lot of individual tech stocks we're seeing get hit a lot harder. Robinhood down 5%, Bitcoin, Ethereum down 5%. Like anything, and I've told you this, if it doesn't have a foundation behind it and it's more speculative in nature, it's the first thing people sell. Crypto is always going to be the first thing people sell if the markets start getting skittish. because there's no value to crypto, unfortunately, for the most part. Like, there's nothing being integrated other than people buying and holding in treasury strategies. So if there's a risk of liquidity, they're going to get rid of the stuff to provide that liquidity, guys. The first thing that is like the most least value to them, which I'm not saying crypto's invaluable, but it doesn't have any substance to it. Like, you're not going to sell a company that's still selling a bajillion iPhones like Apple as material as you're going to sell your crypto wallet, in my opinion. But we'll see how it works out, right? But on the Canadian side, guys, yeah, look at the non-energy minerals. Canada's going to do fine. No reason to sell that off. And we're heading into earnings, which I think are going to cushion any major blow. Really depends on what China wants to do with rare earths. I mean, they're exporting a mass amount of minerals across the globe, magnets, you name it, that are used in a lot of products and chips and all that. But, you know, that's just going to, I think, bolster some other economies, you know, re-bolster supply chain. I mean, it's the same thing Trump did, right? It's just resetting the supply chains. I mean, it's just the world we're living in. 2025 can be exemplified as a resetting of all supply chains because, obviously, of Trump. Things would have just kept trucking along, but that guy had to go all bananas and, you know, it caused inflation and other whatever. I'm going to leave the politics out of it because I'll never invest off any of this stuff. I'm just going to keep buying and holding and hope we get bigger crashes. But regardless, next week, guys, we're getting BCEs coming out on Tuesday after the long weekend here in Canada for Thanksgiving. Johnson & Johnson's going to be posting. ASML, we're going to get some of the major chip suppliers. So lots to look forward to here. Very excited. But I'll pass the question off to you guys. I'd love to know what you think about this insane market down in that comment section below.